And as we were coming out of 2019, where growth had come in at 5.61%, everyone was excited. Interest rate cap had been removed. So individuals were like, finally, banks are going to start lending to us. So we're coming out of that euphoria. We are very excited and we're happy, as in, economy is going to be robust. Then we start hearing the rumors of there's a flu in China. Everyone, everyone is very clear that is a Chinese flu. It will not come to us. But come March, actually February, January, we start seeing Europe, America struggling with this. March, we discover our first case and everything shuts down. Similar case we had seen in Europe, similar case we had seen in America. And one of the key things that everyone was thinking about is how will Africa be able to withstand this pandemic if the countries that we tend to all believe are the countries that are developed, we're not even believing, we know that they're developed economies, they are struggling as they were struggling. We were seeing lives lost, people being carried by ambulances in rows, bodies all over the place. So that is what called for the actual lockdowns that you were saying, so as to preserve lives. We had not discovered ways of how are we going to get through this virus. Uh, so just that whole closure negatively impacted growth in Kenya, and that is why we are seeing the contraction of 0.6%. It's estimated this is actually worse than what we saw during the post-election violence when growth was at 1.7%. If I look at the currency, so just looking at the currency, one of the key things when there's uncertainty, even if it's in a household, the first thing you're going to think about is how much money do I have? And is it in a currency that is not going to be devalued? So the uncertainty that was brought about by the pandemic saw investors rushing to hold dollars. And that now led to what we call depreciation of our Kenya shilling, because now people are selling the Kenya shillings to buy dollars, and they were not caring at what rate they're selling the Kenya shilling at, and that would move up how many Kenya shillings you need for $1, and that is the depreciation that we're seeing there of 7.18. Also, the other currencies like the euro, GDP, and even the rands during that period, shilling depreciated against them. But Kenya being the largest economy within the region, what we saw is the other countries were also now looking for our Kenya shilling. And that now led to it appreciating to by about 6.76 to Tanzanian shillings, and for the UG at 8.34%. Moving on to interest rates and inflation. 2019, as we were coming out of it in November, the interest rate cap was removed. So now that meant banks could start lending. And the other benefit that we could see from that is the parliamentarians had actually come out clearly and said banks will not be allowed to increase the interest rates on the loans that they gave during the period for the interest rate cap. So everyone was happy. We're like, now we can start. The economy is going to perform very well. You can remember from 2016, September to be exact, when the interest rate cap came into place, banks decided they are not going to lend. They're like, we can no longer price risk. There's no way parliamentarians and central bank are going to decide the interest rate that we are going to lend to individuals. Each business is different, their risks are different. So that was where we are coming from. And so right now, even as we're getting into 2020, the pandemic has come and the risk has increased. So banks continue to say, I'm not going to lend to businesses and individuals. Instead, let me take this money and put it in government securities. Because it doesn't matter which season you're in or what struggles are there. The one person we know that never struggles is the government. So they're like, let me lend to the government. And they go ahead and they lend to the government through what we call treasury bills and even treasury bonds. And that's why we could see by the time we were closing, treasury bills were actually at 6.90% because there's a lot of money going in there, pushing them down from 7.17%. Similar state, we are in a pandemic. And one of the key things that we are seeing is the taxes that government get are actually reducing. So taxes have reduced, yet the spending for government has to go up so as to continue protecting our lives. That was the same time whereby if for your PAYE, it moved from the 30%, it went down to 25%. If you're a company, similar thing. So that was reducing taxes, but government has to invest in hospitals so that on the occasion we need the facilities or any of the Kenyans need to go to hospital, the facilities are there. So it's not a case that we don't have anything. So there was what we call fiscal pressure on the government. It needs to borrow for it to now do that investment because the taxes have gone down. If we talk about households, so if we talk about households, a lot of people lost their jobs during this period. It was one of those periods whereby if you're an entrepreneur, your struggles are, I don't have anyone to come and buy what I am producing. On the other hand, you have already produced, so you need to sell it. And there are people you already owe money to. So you can't even pay those people because you don't have anyone who's coming to buy your produce. So it was one of those cycles that businesses were having to shut down. So as a business is shutting down, it's also laying off people. And that was reducing the money that we have in our pockets to spend. So you'd go to a petrol station and then people are also working from home. So you go to a petrol station and it's empty. It's just you and the server, the guy who's putting oil in your car. So those were the kind of situations. Schools are closed, spending has reduced because everyone is not sure where this pandemic is going. People would rather have a little bit more savings, a little extra. If previously you used to buy the best brand of peanut butter, now you're actually just going back to Blue Band. Like, let's just eat Blue Band because we do not know how long this thing is here. So those were the kind of things that we were saying. Then come September of 2020, schools were reopened for the candidates. And we started seeing prices of, we started seeing the prices of assets actually going up. So this is the dark blue line that you're seeing there. So as children are going, the candidates are going to school, we saw a little bit of uptick in some of the prices that we were seeing for the products that we use. So like transport went up, fuel went up, and that is the increase we are seeing of 5.62% in inflation. If I move to the equity markets, equity markets so these are the listed shares that we have, the KCB, the Safaricom, the EABL, the cooperative banks that you see at the Nairobi Securities Exchange. So anytime there's uncertainty, the first asset you let go of are the assets that you tend to call risky. But even as I call them risky, these tend to be the same assets that give the highest kind of return. So the minute we discover our first case, we saw a crash in the markets. So you're actually seeing from December of 2019, a proper crash in the market, mainly because investors are saying these are risky assets. If America has suffered as this much, if Europe has suffered this much, what is going to happen in Kenya? So the foreign investors that are in our market actually sold during that period, where we saw the all-share index down 8.59% by the time we are closing in 2020, NSE 20 down 29.61%. In the equity markets, they tend to be a number of sectors. What sectors and how they react to different information, macroeconomic information. So let me start off, like if you're talking about telco. When the president was reading the first address, one of the key things he said was, let us move our payments to M-Pesa, to the digital platforms. Let's move that. The key person to benefit from this would be Safaricom. And it was very resilient during this period, both in Kenya and even globally, the other telcos globally. So they benefited from that. The sector that gets worse hit tends to be the banking sector. And the banking sector gets worst hit during this period because of, if you look at the business that they do, they lend out money to different sectors. So the pandemic has come in and it's affecting every single sector. There's no one sector we can say is not going to be affected. So whether you're a farmer, you're affected because no one is buying your produce. Whether you're in manufacturing, there's lockdown. People need to be home at 7 p.m. So by 3, you need to have shut down the machines. Whether you're a supermarket, you need to close by 7. People need to have gotten home by 7. You're not closing by 7. They need to be home by 7. So all those businesses were struggling, and banks tend to lend to those businesses. So as the banking sector during that period, we saw a lot of a decline. So the bulk of the decline you're seeing here in prices is coming mainly from the banking sector. Safaricom was the key one that was holding this performance up during that period, even as you're seeing we're recovering up until the end of December of 2020. Moving on to the scheme itself. So talking to the scheme, by the time we were coming out of 2019, the scheme assets were at about 1.7 billion, the ones that we manage at African Alliance. So they were at 1.7 billion. And how the portfolio has been structured is it has been diversified across different asset classes. So the ones that I'm talking about, the fixed income, government securities, equities. So that diversification means when equities are in the red, where the prices have gone down, we can actually benefit from the movement in government securities, which is something that paid off in 2020. So during the period of 2020, so in 2019, when we were closing, we were at 1.7. By the time we were closing in 2020, we were at 1.6. But as of 30th of June, we have actually seen a recovery where we've been able to recover the decline in the asset prices that we saw in 2020 and even surpassed where we had been by the time we were closing 2019. If I just look at the 2 years that you did not have the AGM, so total payments that we paid out from African Alliance came in at 401 million, and the income that we earned from the assets that we have in the portfolio came in at 3.94 million. Moving on to the scheme performance, as of 31st of December 2019, total fund performance for the full year had come in at 17.76, mainly because of the contractions that we had seen in 2020 from the equity holdings that we have in the portfolio. We saw a reduction in that performance. So it came in at positive 7.12%. And one of our key strategies in a pandemic full of uncertainties where we were not 100% sure what is the best way to continue operating within that environment. So one of the key things that we did was to reduce the impact of the losses that would be coming into the portfolio. So how to do that is to adopt what we call a defensive strategy. So become defensive and get in as much income to come in to pay for the withdrawals so that you're not actually eating into the fund itself. So it's the income that is coming in to pay for any member payments that you have to do. So performance for that period came in at 7.12. By the time we've come to June, for the first half of 2021, we've been able to actually already outperform what we had done in 2020. So right now we're sitting at about 8.98% for the first half of 2021. Our outlook for the year, the economy in 2020 is expected to rebound. And this is mainly because of, if you're looking at in 2021 is expected to rebound. If you're looking at 2020, growth is estimated to have come in at 0.6. And this is after we had lockdown after lockdown. Second quarter of 2021, there was a contraction of 5.7, third quarter of 1.1, where we were actually in negative kind of return growth. So in 2021, we've not had such kind of lockdown. We are now very clear on a number of things. Social distancing works. Vaccine coverage is growing. So now we are at a way whereby we are adopting to the new norm. Businesses continue to operate, and we are seeing consumers coming back into the economy. And that is what I'm talking about when I talk about base effects. So those are now positive in our space right now. Then if we talk about inflation, the Lord was gracious last year. Last year we had some really good rains, and that is what supported our inflation during that period. For 2021, we are seeing a situation whereby our long rains were not adequate. But then meteorological department is talking about a new season in between here that they're calling June, July, August. So that should at least help us to increase our food prices. We talk about pump prices. These ones are currently at about 70 USD per barrel, nothing close to the hundreds that you had seen in 2019, 2018. So that gives us a little bit of comfort. Interest rates, so long as we're in this pandemic, you're going to continue seeing measures whereby both from central bank and even government securities that continue to keep interest rates low. Because if you look at the government, they have to borrow and they don't want to borrow at very high interest rates. So they will continue managing interest rates for them to remain low. Speaking on the exchange rate, this will remain a little volatile. So as we're speaking right now, the exchange rate is about 112. So it's going to be a little bit volatile. By the time, and it's mainly not because our shilling is not strong enough. The volatility is coming from the uncertainty. So the variants that are constantly coming from the different variants of this virus that we continue to see, and the fears that it might not, they might not respond very well to the vaccines. And this has been seen where we are seeing people who had gotten the one jab kind of vaccines being told, go back for boosters, because what we thought would work might not be working. So that is the thing that is going to impact our shilling as people continue to feel maybe the virus is becoming too much for us, let's hold dollars again. So that kind of volatility is what will move our shilling. If we move to the equity space, this one is expected to rebound and has also even driven some of the returns that I spoke about up until the first half. So the equities that we have are the same equities that foreign investors are attracted to. So as they come back into our markets due to positive sentiment, we see they come and pick the same equities, and that allows us to lock in profits so as to help us reduce some of the deficits that we're currently seeing in the portfolios in the scheme right now. As I said, for the closure, I'll just speak to one of the funds that we have at African Alliance. And this is what I'd call part of my membership education portion of the presentation. One of the things Mariana spoke about is there's need for you to have at retirement, there's need for one to have what we have, cash flow. And cash flow that is diversified. So even as the scheme is diversifying, you as an individual also need to think about diversification. Gone are the days that you could possibly say, I have real estate, I will continue having income coming through. The pandemic has taught us people could lose their job and you might not get that rental income. So what you need to also do is create what we call passive income. Passive income is income whereby you're not working hard to get it. You've taken the money that you've been saving, or even if you're constantly saving monthly, you're putting it somewhere for you to be able to earn interest from it. Passive income can come from anything. It can be collective investment schemes, like the one I'm going to speak to. It can be through government bonds, which are tax-free. Look at opportunities whereby you're able to earn tax-free income. That tends to be very good for like passive income. So grow those, get dividends. Let me give an example of the late Chris Kirubi. He made his fortune from investing in shares and getting dividends and being able for the price of that share moving up. So look to diversify your portfolio. So just speaking to just one of the funds that we have at African Alliance, I will speak to the Enhanced Yield Fund. So what we have in the Enhanced Yield Fund is, this is a fund that has what we call a competitive return. So it has an effective yield of about 8.95% per annum. If we look at some of the other money market funds that we have in Kenya, you'll realize that this is one of those that we have, and it remains very competitive in that space. My suggestion, if an investor was to look to get into one of the money market funds or like a fund like the Enhanced Yield Fund that we have here, look at what your time horizon is. This fund, this kind of investment opportunity speaks to a time horizon of roughly about 12 months or more. And the reason 12 months or more is because the assets that are being put in this fund are not the short-term kind of assets that CMA approves for. So you're looking at long-term kind of assets which allow you to earn higher interest. So the 8.95. As I was speaking, 91-day T-bill is about 6.7. So the 8.95, for you to get that point, you're looking at a longer term kind of investment. 100% of investments are actually in local securities. It is well diversified across government securities, bank deposits, promissory notes that are actually guaranteed. And then we have one of those, our focus for this fund is debt. So we're not putting any equities in there that might bring a little bit of volatility in there. Everything that is going in there is debt that has been approved by the credit committee. It has also been presented to CMA to look at, the instruments that are in there, mainly to protect investors. So CMA comes in to protect retail investors and individuals who get into collective investment schemes. And then the investment team is all on the ground. So it allows us to be on the front run. So when the macros change, we can see what is changing and how it's changing. So the portfolio is able to remain nimble and take advantage of any macros. Allow me to stop there and to hand over to the chair. Thank you.
Thank you very much, Jacqueline, for that very rich economic review and highlights of the performance of the fund for the last 2 years. Yes, the COVID pandemic has really impacted negatively on performance of the fund, and also for sharing with us this enhanced yield fund that some members could consider. Thank you. So I will now invite Old Mutual. Chris, please try to save us time. Jackie took much of it, but still take enough time to be able to explain to the members the performance of your fund. Chris, welcome.
Is he on board, Chris?
Good morning, Chairman, Board of Trustees, trustees, members, both pensioners and those are active. Good morning. My name is Chris Kari. Morning, Stawa. I'm representing Old Mutual Investment Group, the other fund manager of your scheme. So by way of introduction, I think we are two managers, just for the purpose that the trustees wanted some healthy competition to try and get the best returns for your scheme. I think you had quite a chunk of the background of the economic environment, so I will not repeat what my counterpart at African Alliance has said. Mine will strictly be just to give you a highlight of what we have been able to achieve over the year, and especially focusing on what I think the chairman talked about at his speech earlier about the deficit. We continue to try and beat the deficit. A couple of years back, I think about 4 or 5 years ago, it was about just under 500 million shillings deficit. As you've heard, it has now come down to about half of that amount, and we continue to engage your trustees on how to bring that figure down lower. So members, pensioners, I want to believe you have been receiving your monthly pensions in time. We work closely with the Office of the Secretariat, Mariana, where we avail the money in good time so that at least your checks are ready and you can be able to meet your obligations. So I want to believe that is ongoing, and we want to ensure that that continues and to assure you that as long as we are following our due diligence, we should be able to avail those funds in good time by the investments that we carry out for yourselves. So you'll allow me, Chairman, to go and present my report. Just a moment. So can you see my presentation?
Yes.
Okay, thank you. So let me try and...
Chris, put it in slide mode, please.
Yes, I'm doing that.
Yeah.
Is that visible?
Yes.
Very good. So members, just to a way of introduction, I've got 3 performances that I've listed here: 2018, 2019, and 2020. As you can see, the overall performance I had for that period was 8.4% for the period that we invested in January to 2020 December. So a few challenges, as you've been told earlier. We saw shares coming down by 8%, but our stock of fixed income securities was up by 14%. So that helps to at least improve the overall return to 8.4% for the full year. Compare that to 2019, and you can see that we had a growth of 18.2% in 2019, and the previous year, 2018, at 8%. So this table below shows the comparison between your scheme. The green dark bar is your scheme, and you look at the 12 months column, 8.4% versus the benchmark. We have a benchmark that the trustees give us, which gave a return of 7.5%, which means we have been able to beat the benchmark that was given by the trustees, despite the challenges that we saw in that financial year 2020. And then we go further and try to assess how you have performed vis-a-vis other schemes of a similar nature like yours, size of about 2 billion, moderate risk, meaning you don't want more than 20% in equities. And we look at the median performance, which came at 7.2. So you can see we have not only beaten the benchmark, but also the median return of schemes similar to yours in the year 2020. So I think we've also heard about the outlook, and want to say at least 2021 will potentially be a better year. Already so far, the first 6 months of the year, what we are managing at All Mutual is already 8%, which was actually the full amount for last year. So at 6 months, we're already at 8%, and we want to believe all things are equal, without any certain volatilities, we should be able to continue that journey and maybe deliver a double-digit return for the year 2021. A few upsides, I think, is about corporate earnings on the stock exchange. These ones are coming up well. I think we have seen good reports from the banking sector, good double-digit growth, and that should actually lift the performance of our investments. On the currency, we expect it to stay muted, as well as the interest rates should also stay within the range that they currently are. And I think with that, Chairman, I'd like to bring my report to a close, and I'll fill my Q&A at the opportune slot. Thank you.
Thank you very much, Chris Kari of Old Mutual Investment Group. Yeah, you avoided talking about the economic review for the last 2 years because that was covered well by Jacqueline. And then you've given us the status of your fund as of now and the growth that you have seen over time. And it's very good that you really performed better than some of your contemporaries in the market. So we like that. Now we'll invite the custodian, represented here by Peter Odero. Please, Peter Odero, tell us the state of our funds from your point of view.
Thank you, Chair. And I hope you're able to see my presentation.
Yes.
Thank you. So I'll confirm the assets, what the 2 fund managers have presented, and of course what the auditor shall present to you in a few moments. I'll take you shortly through our role as a custodian and give my report. So as the scheme's custodian, we are charged with the responsibility of making sure that your assets are safe and as well as serviced by way of receiving instructions from the fund manager. So the core responsibilities are 2. Number 1 is to keep the assets safe, and number 2, the servicing of these assets. And we are basically appointed to ensure that these schemes assets are fully safeguarded at all times. So in a nutshell, we keep the assets, be it the cash, equities, all dividends received, all these are kept by the custodian. Transaction settlement of investments, that is by way of acting on the instructions as I've said. Asset servicing, that is collection of income, be it the interest coupon from the bonds. Corporate actions, collection of dividends, participation in asset splits, collection of, if there are bonuses in terms of those listed companies who are not paying dividends, but now giving in a way of shares. We ensure that those shares are collected and credited to the CDS account. We also do report to the Board of Trustees, that is quarterly meetings, and as well as compile the regulatory reports that we send to the regulators. Receipt of contributions, that is in terms of capital inflows, such as monthly contributions. In cases where we have rental incomes, we do collect these and make sure that they are further invested in other asset classes. And finally, we process payments such as withdrawals of members, as well as pay the expenses that are incurred by the scheme. So our statutory obligations as a custodian, we must be licensed by the Central Bank of Kenya. That is to ensure that we operate as a bank, that is a commercial bank. Custodian must be licensed by the CMA as an authorized depository, to make sure that we participate at the NSC. We are also licensed by the Retirement Benefits Authority to ensure that we manage the pension funds. A custodian must maintain segregated bank accounts to ensure that the asset funds, the scheme funds are not, are kept off the balance sheet of the bank. Custodian must also keep proper books of record, the scheme indicating the portfolio health and investment activities, of which we usually do report on monthly basis as well as quarterly basis. And of course, custodian must maintain technical capacity and adequate operational systems to ensure that the reportings are provided as efficiently and accurate as possible. So members, I'll go ahead and present my report, basically confirming the health of your scheme. We confirm that all the assets for Kenya Agricultural Research Institute Staff Retirement Benefit Scheme are maintained in segregated accounts. All investments were executed as per the fund manager instructions. We also wish to confirm that income arising out of the investments was collected in time and further invested. Reporting on assets held under the custody was carried out to trustees as per the RBA guidelines. Members also wish to confirm that assets held are detailed in the audited accounts for the year ended 31st December 2020. And these are the figures. You can see that cash was at 0.1%, deposits and fixed at 2.4%, government security taking the highest at 73.9%, and quoted equities at 23.5%. I wish to stop there, and I will take questions during the Q&A session. Thank you very much.
Thank you very much, Odero, again for that concise presentation, highlighting the role of the custodian to take care of the assets of the scheme, and also working very closely with the fund manager in the process of investing our funds. Now, I'll call upon Francis Kari. I'll call Mr. Kimani Kingori, auditors, to give us financial statements for the year ending 31st December 2019 and 31st December 2020. Mr. Kingori.
Okay. Thank you. Good morning, trustees, members. My name is Joseph Kimani. I would request Mariana to share the report. We had actually shared with the trust secretary.
Go ahead.
So Mariana, project the accounts. So share the accounts because they have actually not been opened.
Can you enlarge a little bit, Kimani?
Yes, Marina should share the presentation. I think she has the presentation. It's not opened. I can't see it on the screen.
Okay, it's sharing.
Stop and
Okay. Huh?
can you see it?
Yeah, that's better. Sheldon? Oh, you have shared it, isn't it? Kimani, can you see that?
Not yet.
Okay.
Yes.
Okay.
I can now see it.
Okay.
Okay. Yeah. I think we have it. It's not very clear. So, members, we have the extract of the accounts for the year ended at 1st December 2020. And we have a comparison for 2019, now that the meeting was not held for the year ended 2019. So we also look at the figures for 2019. And finally, if there will be a question on the accounts, there is a session for the 2 years where members can actually ask the questions. So my name's Joseph Kimani. I'm actually presenting the report for the 2 years. So, let's go to the next slide. Yes, today is that 1st of August, so I'm presenting the accounts. Just brief on our company. We are comprised of a team of qualified accountants. We are licensed and regulated by ISPAC. So we are licensed by Institute of Certified Public Accountants, and I can confirm to members that actually we are in good standing and qualified actually to give an opinion on the financial statements. So we deal with various organizations from audits of NGOs, pension schemes, SACCOs, manufacturing services, and all those other organizations that are actually supposed to be audited. So the next slide. So those are the services that we offer. We do accounting, audits, and all that, including taxes, taxation, and forensic audit investigations. The next slide. So when it comes to audits, we have the responsibilities of the trustees on concerning the keeping of the books. It's important, members, to note that it is a trustee responsibility to maintain proper accounting records and also prepare the financial statements. So our role as actually auditors is actually to examine the books and the accounts is presented to us by the trustees. We do audit tests. So the trustees also implement adequate systems of internal controls to safeguard assets. Remember that the scheme has invested in various categories of investments, and it's actually the trustees who are vested in law actually to ensure safeguards of all those investments. As trustees also are vested with the responsibility of ensuring compliance with all laws and regulations governing administration and management of the funds. So note that we have a Retirement Benefits Act, we have Income Tax Act. So our role as external auditors is to perform independent examinations of the books of account and financial statement transactions of the scheme on a test basis. So it's important to note that we do audit on a test basis. We identify and assess risks of material misstatements in financial statements. We evaluate appropriateness of accounting policies used and estimates made. So the policies are supposed to be in tandem with the requirements and the international accounting standards. We also evaluate presentation of financial statements and also disclosures to ensure fair presentation. A presentation also is guided by international financial reporting standards. So we evaluate how the financial statements are presented to comply with the Retirement Benefits Act and also international financial reporting standards. We also give our opinion based on the audit evidence gathered during the process. And finally, we report to the trustees and what we are doing now to the members in this annual general meeting. So on financial statements, we are talking of various financial statements which are contained in one booklet, which was actually shared to members. We have statement of changes in net assets, statement of net assets, statement of cash flows, accounting policies, and notes to the financial statements. So that is our obligation, actually, to look at all those statements and give an opinion on all of them. So if there's any error, any mistake, it's supposed to actually ensure that it's actually corrected so that we give an opinion on the financial statements, because those are the ones that form the financial statements. So when we go to the financial statements themselves, we have the main important pages. That is a statement of changes in net assets and statement of net assets. So this statement of changes in net assets is the income statement of your scheme. You note that the contributions had actually, we had 81,000 for the member that was remaining in 2020. Otherwise, at the moment, as the administrator reported, there are no more contributing members. So in 2020, we had 81,038, which was actually remitted to the custodian against 1,925,000 in 2019. Other contributions, so this was the employer contribution towards the actuarial deficit. The employer during the year 2020 remitted 2.5 million. On benefits that were payable to leavers, this includes lump sums and pensions, 288.3 million was paid against 295.1 million in 2019. So we had a net withdrawal, net reduction from dealing members, because the benefits that are paid far more exceed the contributions for the year. So the assets, the net reduction from dealing members, 285.7 million against 293.2 in 2019. So the scheme has actually invested in a segregated arrangement. So note that the investment income that was actually earned, and this is what was received by the custodian. From examination, we confirmed 335.6 million was actually earned by the scheme against 362 million in 2019. So this income was actually received by the custodian, and we were able to confirm that all this was credited to the books of account by the custodian. Fair value loss on investment. So this is depreciation in the value of shares, the treasury bonds. It's important, members, to note when COVID came, the share prices actually went down, and this is what we call unrealized loss. It's a 2.7 million, which by now actually have been recovered. So this is unrealized loss on revaluation. So this is not money that has actually been lost, but is actually unrealized loss on revaluation of investments. Investment expenses, these are fees payable to the custodian and fund manager, which are based on the individual contracts that each has with the trustees. And the custodian fund manager were paid 13.5 million against 14.1 million. So you'll note that during the year, the net return on investments has actually declined. 2019, we had 571 million. But 2020, there was 239.3 million. So note that because of devaluation in the prices of shares, that's why the net return on investments has actually reduced. So there were expenses of administration which were incurred, and this we have a breakdown of all these expenses from RB levy, trustee expenses, AGM, and all the expenses that are incurred in administration actually are totaled to 19.4 million against 14.2 million. So these expenses, what we do in audit, we check each and every expense to confirm one is for the scheme, and it is actually incurred for the purposes of administration of the scheme, and I want to confirm to members that this 19.4 million was actually legitimately incurred. So during the year, the assets, we had a decrease in assets of 65.8 million because the withdrawals actually far more exceeded the contributions and also the investment income. So we had a decrease in assets of 65.8 million against an increase of 263.5 million in 2019, which actually was recorded. And you note that the reason why the decrease in assets is because of the benefits that were paid, which were more than contributions, and they were also more than the investment, the net investment return. So the next page is the statement of net assets. And here we have the assets, liabilities, and we have the assets and liabilities. And one of the assets we have is office equipment. There are some assets in the office which were valued at 46,000. The investments make the biggest category of assets, and these investments are actually held by the custodian from the treasury bonds, the shares, and fixed and core deposits. Members, it's important to note where your funds are actually invested. So what we do is we look at the records from the fund manager to the custodian to confirm that these investments are actually held and the values are actually correct. So as of December 2020, the scheme assets, the scheme investments were valued at 3.5 million. And if you note, we had a decrease in assets. Note that in 2019, the investments from shares, treasury bonds, corporate bonds, treasury bills, and fixed and core deposits was 3,573,000, and 2020 it's 3,507,000. So note there the reduction in assets, the 65 million that we actually talked about. So these are the investments that were held, and we are satisfied ourselves that they were available for your scheme, held legitimately by the KCB Bank as the custodian, and they actually were earning the income, which we've actually gone through. So there were current assets. This was money in the custodian bank accounts. There was 4,044,500. So this was the cash that was held at the end of the year. On liabilities, there were current liabilities, payables. These are creditors of 7.8 million, and also benefits outstanding of 542,626, bringing net current liabilities of 3.9 million, and the net assets available are 3,503,445,567 against 3,569,275,548 shillings. So note the assets of the fund actually reduced by 65 million, and we can see the balance sheet showing that reduction very, very accurately. Otherwise, members, our report, which I will just say in brief, we've audited the accounts of the scheme, and these accounts are set out on page 11 to page 26. I believe, and we actually advise that the accounts were shared with the members from page 11 to 26, which comprise of statement of changes in net assets, statement of net assets, statement of cash flows, notes, and accounting policies. And in our opinion, as auditors, we want to confirm that proper accounting records have actually been kept by the trustees, and these accounts give a true and fair view, and we want to confirm that your scheme had actually complied with all the laws. And I wish if members who had gone through the accounts, you will not see any disclosure of any penalties or charges that the scheme has paid, because the scheme had actually complied with the requirements. We have Intermediate Benefits Act, we have Income Tax Act, we have International Financial Reporting Standards. So the scheme, in our view as auditors, had actually complied with all the regulations that govern the management of retirement benefit schemes. Chair, I want to return back to you. Those are the accounts for the 2 years, but we normally recommend to members, because we have a booklet of 26 pages, it's important to go through it year on year to see really what is happening actually in your scheme over the years. Otherwise, thank you very much.
Thank you very much, Mr. Kimani, for that very clear statement of the health of our accounts. And I believe members were given the audited report, so they are able now to go through and have deeper understanding on how accounts look like for the last 2 years. So thank you very much, Kimani. So we'll wait for questions from members, so just hang in there. Now, let's go to the last set of remarks to be given by the Retirement Benefits Authority. Francis Karua, are you there, please? Francis Karua of RBA will say something about the regulator. Okay. Francis? Unmute so that we can hear you. Where is he?
Just in the middle, the third row.
Third row.
Third row, number 4.
Okay.
Oh, this is good.
Okay. Okay. Good. We can see your presentation, Karua. But we can't hear you. Please unmute, Karua, so that we can hear you. Okay. Francis, we can't hear if you're talking. Please unmute. Francis, we can't. Oh, Francis, we can't hear you, and we can see you're moving your slides. Can you unmute him from here? You can't. No, not everyone. Okay. Right. Is he still muted? He's not muted. Then we can't hear him.
He's unmuted, but his microphone
Well, Karua, we can't hear you. Okay, somebody's helping him. Huh? Yeah, because he's trying to get help from.
Can you send a message on the
Chat. Can you send a message on his chat and tell him that you've sent, huh? Okay. Francis, we can see you, but we can't hear you. And, yeah, and you're not muted, so there's something with your system there. Yeah, there you are.
He's talking.
Francis, can you help? Can you get help to work on your audios? We can't hear you. We can't hear.
Okay.
All right, fine. He is leaving the meeting and then he's joining, hoping that then the audios will start working on his side.
Hello, am I audible now?
Yes.
Okay, thank you for the confirmation. So right away, I'll go and share my screen. And apologies for that small hiccup. My name is Francis Karua. I'm a supervision officer at the Retirement Benefits Authority. My colleague Yvonne had
Francis, we can't see your presentation. What's happening?
Is it?
We can't see it here. We should see it. Francis, can you start sharing now?
Yes.
Share screen. Yes.
Yeah, well done.
Now there you are.
Okay, thank you for the confirmation. I was informed by Yvonne yesterday to make this presentation on her behalf. Currently, she's out of the office, so I'll take over you through the RBA's mandate and also where the scheme compliance is in terms of the compliance. Yeah, so the role and objective of RBA is always to regulate the establishment and management of retirement benefit schemes. The other role is to protect the interests of the scheme members and sponsors. RBA is also mandated to promote the development of the retirement benefits industry. RBA also advises on a quarterly basis the Cabinet Secretary Treasury on national policy relating to the pensions industry. And lastly, RBA is mandated to implement all government policy relating to the pensions industry. So recently, RBA was celebrating 20 years of existence. RBA has been in existence since the year 2000. The Retirement Benefits Act being enacted by the Parliament in 1997. So a snapshot of the statistics indicate that 3.2 million members are saving towards their retirement. We have about 1,258 schemes, 11 registered custodians, 23 fund managers, 31 administrators, and 1.32 trillion assets under management. So this is projected to 2.4 trillion by the end of year 2024. So I'll take you through again the regulatory changes that happened in 2020. Yvonne informed me that the AGM was not held due to the COVID-19 pandemic. So I'll just take you through what happened in 2020, majorly the mortgage regulations that happened therein. So the new regulations in 2020 indicated that members can use part of their funds to purchase a residential house. That means the 40% of your balance can be used to purchase a house. Changes in the Income Tax Act, which reduced the maximum tax rate from 30% to 25%. This was to cushion the Kenyan citizens against the economic hardships brought about by the pandemic. And then there was the introduction of a new asset class, which is debt instruments for financing infrastructure and affordable housing projects. So schemes were allowed to invest up to a maximum of 10% of their scheme assets in this new asset class. So our focus majorly on the mortgage regulations. This is where this hot topic was. So the mortgage regulations indicated that all schemes were required to make provisions for this facility within 12 months. That means the deadline for doing this is next month, around 15th of September. So the sole trustee, in case a scheme has one trustee, shall set minimum qualification requirements and procedure for purchasing a residential house. The amount to be utilized for this purpose will be the lower of 40% of the members' accrued benefits in the scheme, or 7 million, or the purchase price of the house. So the above limits will be subjected to the financial position of the scheme. This means that if the scheme is having any deficits in case of a DB scheme or is having unremitted contributions, then the unremitted amounts cannot be used to cap at the 40%. So 100% of the members' AVCs, that is the additional voluntary contributions, can be applied for this purpose. So there have been many questions from industry participants on why we decided to cap. So one reason for the capping was that there was an actual outflow of funds. So as a result, the income replacement ratio of the member is affected. So the other reason for capping was having sufficient income at retirement, which is the primary purpose of contribution to a pension scheme. So the other aspect was to safeguard the liquidity of the scheme. And the last reason for capping was to protect the capital markets, which could be destabilized by mass liquidation of investments. So the mortgage regulations, nitty-gritties about this is that the house must be occupied for residential occupation. So no construction or purchase of land is allowed under these new regulations. So the member may only utilize this facility once, but joint purchase by spouses is allowed, whether in the same or different schemes. So the post-retirement medical funds and remitted contributions are excluded for use in determining the 40% amount. The pensioners and retired members are not eligible. So that means if members want to use this facility, then they can only use it during their working lifetime before the age of retirement. So the funds will be deemed to be drawn from own contributions first for withdrawing members. So in case we have any members who wish to withdraw from the scheme, then the 40% is based on their own contributions first, and then the balance is based on the employer's contribution. So the facility cannot be applied to offset or exiting mortgages and loans. So the members should bear the transaction costs, including the stamp duties and the various taxes. So the house shall be encumbered by trustees until upon occurrence of the following events: retirement, death, or immigration of the member. So there have also been questions on why we decided to encumber this title. So the main reason for encumbering this title is that the members' rights at when they're exercising this option to access their benefits has not yet crystallized at the point of house purchase. So, and then the other reason for encumbering this title was to prevent abuse of the member of selling the house immediately after purchasing it. So there have also been other regulatory changes. This happened way back in 2016. That's where the regulations were laid down on post-retirement medical fund. So I'm sure that the trustees are aware of this and the members are aware of this. So the regulations were amended in 2016 to allow scheme members and employers to contribute to a medical fund established within the scheme for purposes of securing a medical cover at retirement. So subsequently, the law has been amended to allow members who are unable to sufficiently build medical funds to transfer a maximum of 10% of their retirement benefit schemes to a medical cover provider, as though this was in 2016. And then now there is a new budgetary change this year where the members will now be allowed to contribute to a standalone post-retirement medical fund. What this means is that the member is allowed to contribute to like an IPP, like how the IPPs operate, that is the individual pension plan. So you don't have to contribute to the employer's post-retirement medical fund. One is free to contribute to any post-retirement medical fund that is registered under the RBA Act. So the administrator took you through the members' rights, so I'll just go through them quickly. So one of the rights is the immediate vesting of benefits. Your benefits after being deducted from your payslip are invested immediately by the fund managers. And then there should be no discrimination on gender, race, religion, or tribe and job grade under this pension scheme. If you are willing to transfer your benefits from another scheme, then this should be done within 30 days. Your payment of benefits should be done within 30 days. So these benefits cannot be attached to any form of a judgment, debt or loan, or form of impropriety. So you have a right to elect your trustees and you have a right to approve their remuneration. So the member is also entitled to receive an annual benefit statement after the release of the audited accounts. The summary is also available to you by the auditor. Then the member is normally required to question any anomalies in the audited accounts and access to the investment report of the scheme funds and also attend the annual AGMs. So in terms of the compliance of the scheme is that the good governance policies, the deadline for submission was on 30th June 2021. This is for the schemes that the service providers have confirmed that as well. So that is for me. Thank you for the opportunity, Chair, for allowing me to present to the members. And I'll take over from here to the Q&A session where members will be allowed to ask questions. So thank you, Chair, and hand over back to you. Thank you.
Thank you, Karua, for that very good presentation by highlighting some of the developments within the pension scheme industry according to the RBA regulations. The mortgage regulations, you have highlighted them very well, and I'm sure the administrator should be able to share that with members. And also the post-retirement medical fund is very good. Also, thanks for highlighting that we are compliant with RBA statutory requirements. Apart from that, submission of good governance guidelines, and I can attest that they are ready now for submission. Maybe it's only that we didn't meet the deadline. So, members, we have come to the end of the presentations that we have prepared for you. And now in the session, we are calling question and answer session. And to ensure that there is order in asking your questions, it would be good if you can use the facility within your Zoom for raising your hand. If you're not able to do that, just put on your video and just raise your hand. I can see it. Then I'll ask you to, I'll give you permission to ask your question, please. So let's start now from asking any points of clarifications, questions, or any comments that you'd like to make. Yeah, Mr. Starr would like to add something. Mr.
Starr. Members, this is now the area where you are allowed to interrogate any part of the AGM, any of the reports, any of the presentations made. You can also indulge the board on matters arising from the minutes of the last AGM. As you know, that was the last AGM which was held in 2019. So it is right from the confirmation of minutes there. If you have any matters arising from the minutes that you'd like to seek clarification, or even just to question maybe a matter of procedure, from the chairman's report, the administrator's report, the fund manager's report, the custodial report, the financial statements, which forms a critical part of the scheme activities, and then also the remarks from the RBA representative. As the chairman has stated, we will field at least 4 questions at a go, get answers. The chairman will answer most of the questions, but also where he feels other trustees can come in to assist, even the administrator, he will guide us accordingly. So members, feel free to ask any question, any issues that you have that are personal to you, or that maybe collectively as members we feel that there are issues that affect us. The floor is open to you.
Thank you, thank you. George Wanda, do you have a comment to make?
Wandeto.
George Wandeto? We can't hear you, George Wandeto.
No, I think he just put on his camera.
Okay, fine. It's okay. He's just relaxing. Okay. Go to the screen. Go to the others. Okay, fine. Go to the gallery. All right.
Dr. Waiganjo is.
Dr. Waiganjo, yes, Dr. Waiganjo, please go ahead and ask your question.
Thank you, Chair. I had asked during the chairman's report, he mentioned about staggering the terms of trustees in compliance with good governance. Kindly explain what that means. My second question was about getting dividends from the pension savings, like what happens in other saving organizations. Then I had also wanted to know how these assets benefit the retirees. Can we be told how they benefit the trustees? And finally, can we be told in a more clearer way about the post-retirement medical fund that has just been mentioned by the last speaker? I think it was Mr. Karua. Thank you.
Thank you very much, Dr. Any other comments? Okay, fine. I think let's first of all tackle these four, and I'll request that the issue of staggering terms of trustees and post the retirement medical scheme to be handled by Mr. Karua of RBA, because these are governance guidelines that they have given us. Then I'll request Mariana, our administrator, to talk about the question regarding the dividend from pension savings and how members can access to those earnings. Francis.
Thank you, Chair. Through the Chair, I'll handle the two questions. That is on the staggering of terms and an explanation of how the post-retirement medical funds operate. Thank you, Dr. Monica, for the questions. So the reason for staggering of terms of trustees is to ensure the continuity of service of the scheme. So scheme is a trust established under the Retirement Benefit Act and is normally managed by trustees. So where we are having elections so where we are having these elections happening at the same time, that the trustees are retiring at the same time, then there are these voids that are normally available. That is, the new trustees have no experience. They need to be trained again by the TDBK. So it's normally recommended that there is one trustee who is experienced in terms of managing the affairs of the scheme. And that's the reason why the good governance policies require the guidelines, require the terms to be staggered. So at any point in time, we have some experienced trustees who are well trained through the TDBK program, and we have the new now trustees joining. The second question was on the post-retirement medical fund. So the post-retirement medical fund, these guidelines were issued in 2016, is a fund established to cater for the retirees. That is the people who are retiring at the age of 60 and above. So recently, as you may be aware, in the market, it's hard for the people the senior citizens of this country to obtain a good medical cover, majorly because of this selection risk by insurance companies. So what RBA decided is to come up with a fund that can negotiate better rates for these retirees. So the post-retirement medical funds basically are DC in nature, that is defined contribution in nature. So they operate like how you contribute to a pension scheme, that is the one that you're currently contributing to. So by DC, I mean there is an employer portion of contribution and the employee portion. So this will not operate like the normal defined benefit scheme, whereby the employer funds the balance. This will operate in such a way that the member is contributing a certain proportion, a percentage of his or her salary, and then the employee or the employer is contributing their portion of contribution. So there is a recent budgetary change in the, this is yet to be gazetted, whereby now members will be allowed to contribute to a standalone post-retirement medical fund. So this means that you do not have to contribute to the post-retirement medical fund of your employer. You're allowed to go into the market, go to the service providers, and get a list of the registered the post-retirement medical funds and the RBA Act, whereby you can save towards your retirement for these funds. So normally what happens at retirement is that the fund managers or the trustees of this post-retirement medical fund will negotiate a medical cover, a good medical cover for you that will cover your medical needs at retirement. So the reason for this post-retirement medical fund basically is to secure medical cover at retirement for retirees retiring at the age of retirement. Thank you, Chair, and I beg to submit.
Okay.
Thank you very much.
Just a clarification.
Yes.
Yes.
Through the chair.
Mm-hmm.
Yes, thank you.
Are you able to negotiate this before retirement? Because I've not really heard about it.
The negotiation process starts whereby the member retires. The member leaves service. This is where the trustees of these post-retirement medical funds negotiate the cover for the member. So this does not happen before retirement. It only happens at the point of exit, whereby the funds that you have accumulated in this fund will be secured, will be used to purchase an affordable medical cover that will cater for your needs at retirement. So the point of negotiation starts whereby the member exits the service.
Thank you, Francis. Mariana, please.
Okay, thank you. Through the chair, I would like to address the two questions on how the assets benefit the members. And I will address specifically for our scheme. We are a defined benefit scheme. And that means that we pay pension for life. So members are paid pension for life. And so the assets of the scheme give an assurity for these members that there will be money available for the rest of their lives. So the assets are there to ensure that members get their monthly pension. And the other thing is about dividends. As the name states, it's a retirement benefit scheme. So basically the benefits are meant to secure your retirement. So you only access them at the time you retire. And unlike the SACCOs and the other which pays the dividends, the interest in this case is actually plowed back so that you can access it at the time of retirement. So the assets are meant to ensure that the benefits are paid for the rest of your life. And you can imagine if for the rest of the life, there are people who live up to 100 years. So these assets, you cannot really sustain them with the amount you contributed, and it's not being invested. So the money is invested and it is to ensure that your pension is paid for the life. So we encourage members to live healthily. They may live as long as 100 years, you are sure that your pension is paid. Thank you.
Thank you very much, Mariana. Very well put. Unless Francis has got any addition to make from RBA's perspective. If not, then we'll continue with the questions. Thank you, Dr. Iganja, for asking those 4 very important questions. They have enlightened the members. Good. Who was asking a question there? Mm-hmm. Is there anything in the chat? Well, the sound on their side is bad. I don't know what to do about that. Okay, any more questions? Okay. Right. For the manager's presentation, any comment on that? Oh, Difina Adima, how are you? Please go ahead and ask your question.
Thank you.
Please go ahead.
I'm fine, thank you. Yeah. I would like, thank you for giving me this opportunity to contribute. I would like to find out from RBA how I can access the 40% that has been allocated or has been allowed for the pensioners to use for either building a residential house or stuff like that.
Very good question, Adima. Very good question. Francis, can you answer that, or we get a few more?
Thank you, Chair, and thank you, Infina, for that good question. Just to confirm is that, one, these funds can only be used to purchase a house. So constructions are not allowed under this facility. And the 40% access, this is going through the changes that are going to be made to the trustee and rules by the trustees. So these policies are expected to be submitted to the authority or the new trustee and rules with these new policies next month. So from there now, Limfina and the rest of the members, you can apply for access of this facility through your elected trustees. So the trustees will spearhead this process to ensure that you get the 40% access. Thank you, Chair.
Thank you, Francis. Does that apply also for DB scheme, or it's only DC?
Yes, the 40% access is for both DB and DC schemes.
Thank you.
So if a member is having the 40%, then this can be accessed from either of the two funds.
Thank you very much. So, any more points of clarification? Thank you, Difina, for asking that good question. Yeah.
One more, please. I'm sure it will be tied to certain restrictions. For example, in the past years, we've been asking that question, and what we've been told is that you need to go through probably a bank, and the scheme will have the money paid to the bank, and then you can be able to access for whatever you want to buy, or to buy land, or whatever it is. Now, my concern is that the restrictions should be flexible, in the sense that if somebody wants to get the money and do the purchase themselves, I think that would be more appropriate. I'm not sure whether that will work, but if RBA could look for a more flexible way of doing that. It's just a comment. Thank you.
Good, Difina. Thank you. Francis?
Okay, thank you, Chair. Yes, there have been many questions on why we did these encumbrances or these restrictions. And the reason why these mortgage regulations were developed was in tandem with the Big Four agenda on affordable housing. So the government was looking forward to making more citizens own homes and stop renting. So the agenda, basically, the deliberations that were made was that these funds should strictly be used to purchase a constructed residential house that is ready for occupation. And the purchase process was discouraged, or the construction process was discouraged. These mortgage regulations are not new. We have the old mortgage regulations of 2009, whereby members can use up to 60% of their funds as collateral to secure a loan or to secure mortgages from a bank. So you're allowed to use up to 60% to do this. But this 40% is an actual outflow of funds. That means the member is allowed to access the funds before the age of retirement. So that is why RBA saw there is a risk whereby these funds could be channeled anywhere, could be channeled somewhere else where the original intention was not intended for. So yes, there is the old mortgage regulations of 2009 that allow for access of mortgages using your pension. And then the new ones are now for citizens or members who want to own homes for the first time. So that was the idea behind coming up with these new mortgage regulations. I hope Madam Damfina have answered your question, and through the chair, I beg to submit.
Okay, thanks, Francis. But Mr. Stava would seek some clarification from your response. Mr. Stava, please go ahead.
It's just a clarification to be made. Some of our members, especially the pensioners, would be wondering whether this is also applicable to them. Would we just get that clarification from the authority that if it's applicable or not to pensioners?
Is not available to pensioners. Is only available to members who are saving towards retirement. So for the current pensioners, then this facility is not applicable to them. So I can confirm that.
You can just clarify the cost of that purchase. The 40%, is it supposed to be enough to purchase, or somebody can just access it and then do an addition, or must he have already? Should the 40% cover up to the total cost? Because members the 40% of the members' benefit may be something very small, and the cost of the house could be higher. So at what point do we release that?
Yes, thank you for that question. Yes, the 40%, yes, can be literal. Remember, we are looking for the lower of the 40% of member accrued balances, or 7 million, or purchase price of the house. So whichever is lower is the one that is going to be applicable for the purchase of this house. Yes, the members are allowed to top up using other sources. For example, other savings from circles, from all these other financial institutions, or from own savings. But the maximum allowed amount to withdraw for this facility is the lower of the 40% of member accrued balances, or 7 million, or the purchase price of the house. So in case the members' funds are deemed to be lower, then they can be used in conjunction with other sources of income to purchase the house. So that is quite allowable. Thank you.
Festus Murithi, I saw your hand up. Please, go ahead.
Thank you, Chair. I hope you can hear me.
Yes.
Yes, thank you very much. First of all, I wanted to appreciate the presentations which have been given by all the team members. It was very informative, and we appreciate the information you shared. Mine is just a question which may not be within the scheme we are discussing now, which has been presented very well. But I just wanted, because of the experts, maybe they can tell us how we can progress on that area. As one Marianne saying, our scheme, the one we are discussing, started in 1995, and some members were in the ministry scheme, And why I'm asking the chair is because sometimes we have interacted with the colleagues who have retired, and where we appreciate what Miriam said about what we get from our scheme, the Kari scheme, we did that and these people get their benefits and everything. I'm wondering, because you have warned that many of the colleagues who retired and get a lot of challenges getting the benefits from the ministry scheme. Is there anything the team here can be sharing with the team members, with the scheme members, at least to be prepared on what is required to assess the ministry one, the benefits? I know it, but I'm asking this because we are still members, but we can get some ideas, some advice. I want to be prepared so that one doesn't get the shock that we are colleagues get the benefits from the ministry. And if it is not possible to address this one because it's not within your management, it's okay. It's just a concern. Thank you, Chair.
Dr. Moridi. So Mr. Day is joining online. Mr. Day, are you there to respond to that? If not, then Mariana will attempt to respond to you. Mariana, please.
Okay, through the chair, I'm just trying to attempt. One thing I've realized, these letters are issued one year earlier, so the requirements are actually listed, and the office that handles the ministry pension is actually housed here. So what I would advise is, after you know the requirements, you engage them, and maybe you start the process. But I know, yes, there are so many people who have not gotten the benefits. And I think there is need for the organization to really see how they can ease that one. Maybe this is something we just need to give feedback to the HR. They see how they can smoothen that process.
Yeah, Mr. Jao, please.
Okay, thank you, Dr. Moridi, for that concern. It has been a concern for a long time. But what happens is that from this end, we prepare the voucher, and the voucher on the bit from our side is forwarded to the ministry. So once it gets to the ministry, what happens is that that voucher is taken to Treasury, and a file is opened in the Treasury. So once it gets to the Treasury, what do they normally do? They consolidate all of them and look for funds. So once they are in the Treasury, we don't have any other control, because even if you followed, you are told now that is in the Treasury. So that is what happens, and that is why the reason there is a delay in that matter. Thank you so much.
Thank you, Mr. Jao. Also, there's a delay in getting the appropriate documents for processing the request, and sometimes I know some members who said that they can't trace some of the documents, the letters they were appointed with. So anyway, like Mariana said, there's a whole 1 year to sort out that. One should not wait until maybe now when they retire, that's when they're having problems. Because the letters are issued 1 year in advance, and the requirements that are required for you to process ministry pension are really well stated out there. But nevertheless, we'll pick that one up as an issue and give it to HR people to ensure that members are well prepared even before they leave the service. Thank you, Mr. D. Sorry, Dr. Moridi. Any other comment, please? Yeah. Day is there. Mr. Day, are you there? I can see you, Sami.
Hello, Chair.
Yes, add something.
Yes, Chair, thank you. I think Dr. Moridi is concerned about the documentation that are required for one to access the benefits. Usually the 1 year notice is supposed to be sufficient for one to start gathering those documents, and the process once they have been consolidated and brought to the HQ, then as Mr. Njau did explain, we raise some funds to cover the period one has been in the organization prior to joining the pension scheme in 1994, that first 1994 December. So usually we do computations from 1989 or whatever date one may have joined the former organization. So therefore, a check is processed and handed over to Treasury, and then the file is again passed on to the ministry. And usually the ministry would then require that those documents are attached, so that then they can also do their pension element for the period from the time of employment to the time of the transition to the former organization. So then those payments are at Treasury. At that point, usually we have no control, and the officers are required to have process all the documents, including clearance from from income tax department or KRA, and any other clearance that is required, particularly on tax matters. And then as soon as that is done, then the process starts, and the file is opened for the former members, so that then they have an identification from the Department of Pensions. So it takes a while because usually the pension departments organizes their own payments according to their available money in terms of the budget. So usually they have a schedule. But we would also wish to advise members to ensure that they have all the documents. And for those who may not have been confirmed in appointments, the best they can do is to confirm, to indicate that never happened, but they should not be concerned or worried, as long as they have been able to indicate that never happened. Usually the Ministry of Agriculture is able to give the confirmation as soon as they have received all the documents. And then from that point, then they're able to process. But I can also confirm that Treasury takes much longer to confirm the receipt of the funds to cover the pension period that one served in the Ministry of Agriculture or whatever, or maybe former organization before joining the current pension scheme. So it takes a while. While we normally do the banker's check, it still takes much longer for them to acknowledge, and therefore that also delays the process. And I think the only way members are cushioned is by accessing our funds from our current scheme. I think that is all that I can say.
Thank you very much, Mr. Day, for that information. Very useful. Thank you. More questions, please? Mm-hmm. We still have a bit of time, so if you've got a question to ask, please feel free to ask one or two. All right. Looks like everybody is happy with the presentations.